good afternoon, ladies and gentlemen. Very welcome, a warm welcome to all of you to join us this afternoon for our panel discussion. We will be discussing on evaluating the financial performance, organic growth strategies, and dividend yield of the Asian Pacific REIT. Very privileged this afternoon to be moderating this session with a very illustrious list of panelists. Just to kickstart the process, I think I want to do a bit of overview of the current market situations here. And generally, I think the Asian REITs post the financial crisis have enjoyed actually upbeat 2011 and 2012. And I think for that matter, the Asian REITs have actually been in the acquisition mode since 2011. And in particular, I think we talk about the S-REITs here because we are in Singapore. And in here, I think the S-REITs have dominated the cross-border transactions in the region. And now close to 38% of all the REITs in Singapore actually hold assets outside Singapore. And for Hong Kong, I think perhaps George could comment on that later, it's actually emerging as an offshore REIT center for assets based in China. So with the Hui Xian REIT, which is actually listed in RMB, last year, we see that possibly as an emerging trend. But of course, beyond the REITs, these are perhaps the positives, but the challenges I think facing REIT now could well be fundraising, equity fundraising. We see a few IPOs, especially the hospitality front. The few REITs that could have been listed this year didn't happen because of the economic instability. So with that as backdrop, there are obviously concerns around financial performance, organic growth, inorganic growth, and dividend yield strategies of the Asian REITs. So for a start, perhaps we could have our REIT managers share with us what are your views on financial performance generally. Perhaps we could have Lynette sharing with us in terms of what do you feel as a REIT manager, how could you improve the financial performance of the REIT you're managing, and what are the investors' views or unit holders' views in terms of what constitutes financial performance? Are they happy with how the REIT managers are running it?
I think most investors would be looking at DPU growth as one of the benchmarks. Other than DPU, they would be looking at the balance sheet and how the track record of REIT managers. In CCT's case, we are invested primarily in office buildings in Singapore. And if most of you are familiar with the office market in Singapore, it's been through some shake-up, as in the correlation with the economic environment is very high, and therefore rents are also affected. So we have been through kind of from the peak of 1880 per square foot rental to the trough of $8 per square foot, and now we're about $10 per square foot. So rents are still about 45% below the peak levels. And we've been through a cycle of negative rent reversions because of rents having been signed during the peak. And when they're renewed now, we are faced with all these challenges. Nevertheless, I think we have gone through this period of a lot of bruises, and now we're healing from our wounds. And I'm happy to say that this could be the last year when we experience the negative rent reversions for most of our leases, because we've gone through this whole cycle. So from the DPU perspective, it's not just about the top line number, but we have to manage our costs very effectively. Costs in terms of the operating expenses, as well as financing, the borrowing costs. So in terms of the operating expenses, we take a very proactive view towards managing the very large ticket items. And there are two very large ones. One is the utilities, the other is property tax. Utilities, we do that by having bulk purchases, and also we have our buildings as green as possible. Environmental sustainability is one of the key focus of the REIT. And most of if not all of our buildings are green certified, some as high as platinum, which is the highest level of sustainability. So that will help to reduce our utilities charge. And then for property tax, it's something imposed by the government, but we also proactively debate over whether that's a correct figure or not. And we've had a lot of success in that, in getting refunds. So, and then borrowing costs, we also finance our debt very early. Our gearing is now at a very low level of 30.5%, and that's through having been very proactively managing our capital. So in terms of, being able to deliver better DPU every year, we are compelled to, in some ways, due to the decline in rentals, we had to really take a very proactive approach towards managing our expenses. So last year, our DPU, while rents had fallen by, like I said, from the peak of 1880 to like $10 now, it's 45% below. Our DPU only fell by 5% last year. And this year, well, I cannot make any forward-looking statements. So, but I'm just happy that this will maybe the last year that we're facing negative rent reversions.
Thank you, Lynette. I think going forward, having heard the office sector, perhaps Dr. Choo, your views on the retail sector.
Okay, thanks, Lin Choo. As you heard from Lynette, I think as investors, you will be looking at the DPU, as well as, I believe, the appreciation in the share price. And of course, that gives you the total return. But I think most of you also want to impute some kind of risk adjustment to it. So if you go for a high-risk stock, for example, and you make a huge return, indicates either shrewd judgment or very lucky. Whereas there are some risks that are very stable, and they give you decent returns without too much risk. My REIT happened to operate in a sector that is more resilient, namely the retail. And the assets we own also happen to be suburban retail, which, if you are aware, even during the global financial crisis, continue to receive positive rental reversions. So in a sense, we are in a blessed environment where ever since listing on the stock exchange, the rental reversions have always been positive. DPU has increased every year without fail, so every year is a record year. Although the numbers are not spectacular, you will still be looking at a compound average of 6 to 8% per year over the entire lifetime of this REIT. So in a sense, the quality of the underlying assets and the kind of assets it is actually plays a big role in how you look at the financial performance of the REIT. Then also picking on what Lynette said, REITs that take high risk by having a high gearing, by borrowing a lot during the low interest rate periods, of course they'll give you higher returns, but that's at the risk of things going wrong. So it's good to note that right now in Singapore, at least among the S-REITs, the capitalization of REITs have now reached a very sound level where most people are below 40%. CCT, as Lynette says, or 30, so are we. And there are even people below 30, even in the 20s and below 20 as well. So I think in general, it's a very healthy set of affairs. Beyond that, to look at financial performance, I think as longer-term investors, as most REIT investors are, you also want to just judge the manager for his soundness. So that includes, of course, maintaining good capital structure, but also in the acquisition. It is okay to acquire something that's accretive, but however, if that asset has got little room for growth, then all you get is instant gratification, and then beyond that is just a maintenance job. So I believe if you look carefully, there will be REIT managers that are much more astute in acquiring assets, which will in turn translate into positive financial performance. On the other hand, also, there are people who are just as good at rejecting tempting opportunities. So overall, if I were to just summarize how I feel about the state of affairs in the S-REIT sector, I think things have been going quite well. As you noticed over the last week, most of the, it's a very short period of course, but the prices are, some of them are reaching record highs among some of the REITs. And this is a reflection of both the sentiment in the market, that other stocks are volatile but REITs are safe havens, but also the fact that most have given decent returns. So I'll pass the time back to Choo.
Thanks, Dr. Choo. I think we all would agree that as an investment class, I think REITs have been giving very good returns to investors, especially pension funds, insurance houses, and the likes. Perhaps we shift on to Hong Kong, to the Link REIT, the largest REIT in terms of market cap in Asia, and how how the REIT is performing and how the unit holders feel about the financial performance or the expectations in the Hong Kong market.
Okay. Well, we have been very lucky benefiting from the growth in retail sales in Hong Kong in the last few years. When the global financial market hit at the end of 08, 09, our unit price went down to around $10 Hong Kong, and now we're back to about $31. Last year, our reversion rate set a recent record of 22% increase in rent. And our tenant turnover have increased 10.7% on average. So based on a 3-year lease that we typically have in Hong Kong, the margin actually grow if you average 21%, roughly 7% a year. Our lease expiry profile also has been set up as having roughly 1/3 maturing every year. So that gives us the stability of slowly growing or slowly maturing over time. Occupancy have increased in the last few years. For our shopping centers now about 96%. Unit rents went up 9.1% year on year. So all very healthy statistics. DPU grew 17%. From our IPO at the end of 05 until end of March, we have delivered total return of both unit price increase and DPU increase of 22% on a compound annual growth basis. So our unit holders have been very happy. Gearing continued to be very low at 15.9%. And we have a A2 rating with Moody's, which allowed us to raise some very low cost funding. Last week we raised a 15-year bond at 3.6% fixed for 15 years. So very healthy funding for us to look for acquisitions. We're also quite concerned about costs. So similar to what you've heard from other speakers, cost is a big factor with inflation in Hong Kong. Last year we managed to save 16 million kilowatt hour of electricity. I set a very simple but very tough target to our team that we need to save enough kilowatt hours to offset whatever tariff increase that our two electricity company announce every year, which is very difficult because it seems like until recently that energy price will keep going up. The other thing that is a probably bigger concern to me, if there's one thing that wakes me up, is a shortage of labor in Hong Kong. And some of our, especially the low-skilled workers, whether they are supplying to our tenants, especially in F&B for being waiters, dishwashers, and all those people. Hong Kong started last May to have minimum wage. Overnight, the low-skilled worker basically have a 40% increase in their pay. And it's good for them, and it has been good for us because we have our base, our customer base is the mass market the majority of the people who benefited from the minimum wage legislation lives and shop at our shopping center. So our tenants actually have seen fantastic business, given that the capacity to save for low-income group tend to be very low. So every dollar that they spend are buying things that they want last year. So our tenants have continued to enjoy what the government have imposed on our tenants. But what we have also seen is that with minimum wage, most people would rather do an easier job than to be, say, we have excess supply of people wanting to be security guard walking around shopping center doing nothing, but they don't want to be a cleaner because you get the same wages. Why do you want to work that hard? So we can't find enough cleaners. We can't find enough people doing odd jobs, fitters doing maintenance. The government's doing a lot of infrastructure work, and it's now moving to the A&A stage as well, the fit-out stage. That takes also a lot of the workers that we need for our asset enhancement. So we have seen construction workers, especially those doing interior work, wages have gone up 150% in the last 2 years. That has a big impact on our capex costs. But otherwise, these sort of works in cycle. As the wages get spent at our shopping centers, we get it back in our rental. So it's not all sort of bad news. The other thing that we have done last year is that we started to grow inorganically. We made our first 2 acquisitions since IPO. Both of them have performed very well. 8% increase in valuation in 10 months up until year end for our first acquisition. And we have been able to improve the tenant mix in the property that we acquired. So we're looking to do more given the interest costs and other funding costs for us continue to be attractive. We are trading at a premium to NAV right now, which allowed us to look at equity funding as well if we need to. Thank you.
Thank you, George. Having heard the asset manager's point of view, perhaps we could shift our attention to a global investor's point of view. So we can have John share with us the views about financial performance. What are the key indicators as far as financial performance is concerned for investors, global investors, and whether a yield that just beat inflation, is that good enough, or you're looking beyond risk return, what sort of return for what class of assets, and across Asia, which are the countries that may be of interest to global investors?
That's a big question. I'd probably start off by saying that when we're looking at portfolio construction and asset allocation, is we undertake a couple of or 3 different modelling techniques. We look at constructing a macroeconomic model of the individual markets that we invest in, and also assess a model on the property markets, and then go into the financial modelling of the individual stocks that we cover. So we make a number of assessments and forecasts from a top-down, from an industry level, and also from a company-specific perspective. So in terms of that, I think when we're allocating and when we're looking at financial performance, we're looking at the relative growth prospects, inflation rates of the individual countries that we cover. We're looking at where the markets are in their property cycle, supply-demand characteristics, where rental growth forecasts are for the individual asset classes. And then we build them into our stock models and make forecasts on the back of that. So when we're actually selecting a security in our portfolio, we're looking at return on capital employed as the primary driver of the financial performance assessment of the individual stock. So we look at 2 things. We look at the income level and the growth on the income level, and the sustainability of the dividends, the volatility of the income flow. So currently at this current juncture in the economic cycle, we don't have too much of a constructive view on the office market, so we're probably hiding within the retail asset class at the moment, which has a much lower volatility characteristic in terms of its income performance. And as George mentioned earlier, the rental reversions are actually quite strong in the retail sector, whereas in the office sector, Lynette's encountering some roll downs over this year. So we look at the sustainability of the dividend, but we also look at the sustainability of the net asset value and the growth in net asset value in the balance sheet. So when we make our assessments, we're looking for a growth at the top line, the income line. We're looking at growth at the NAV line as well, and making a relative assessment of the REITs across the region: Japan, Hong Kong, Singapore, and in Australia. In terms of looking at REITs, we're also comparing the returns from those types of vehicles with the developers that are on offer in each of those markets. So quite a complex analysis. I think the prospects for growth, particularly in the Singapore market right now, stronger in the retail sector at this stage. But what I would say is that, given that cost of debt is quite low at the moment, the ability to refinance debt at cyclically low interest rates are quite constructive for some of those stocks that are trading below their net asset value, such as the office stocks at this stage. So we're not necessarily too bearish on that sector. We think there's value, particularly at, say, 30% discounts to NAV at this point in time. In terms of, I guess, how we're looking at the financial performance from country to country, at this stage, I think we're broadly more positive on retail in Asia ex-Japan. We are looking for a recovery in the office markets in Japan. However, the recovery always seems to be about 6 months out, and we've still got some rent roll downs in that market that we need to contend with. In terms of Australia, we're actually a little bit bearish on the Australian REIT sector right now. It's very much a play on the consumer and household deleveraging, particularly in the retail REITs and the REITs that are exposed to the residential sector. So at this stage in the REIT world, we're actually overweight Asia ex-Japan, probably market weight on Japan, which is showing signs of good value, and a little bit underweight on the Australian market.
Just curious, as an investor, because there are a whole host of pipelines on hospitality asset class as REITs here in Singapore. What are your views from all the investors' point of view in terms of the class of hospitality assets in Singapore and Asia?
I think they're a good investment prospect at certain times of the cycle.
As of
now? Some stocks seem attractive. I think Mark can probably comment a little bit more about what's going on in terms of the pipeline there. But I think because it's a highly cyclical market, we would be more inclined to buy stocks when they're trading at discounts to NAV, and probably getting out before they get too expensive. So I think the risk-return characteristics of hotels is probably not as attractive as retail in our perspective, but I'm happy to debate that point.
Sure. I think obviously our discussion or debate will not be complete without the banker's point of view on how we feel about financial performance. So without further ado, Mark, your views on financial performance indicators from the bank's point of view, whether from the equity, debt, financing, and generally.
Okay, thank you. I think with respect to REITs, in a relative context, remembering we're in a very volatile world at the moment, REITs in this part of the world are in a pretty good point in time. You've got the Singapore REITs just trading just below NAV. Average gearing's a little bit over 30%. George has probably got the most competitive cost of capital of any REIT in the world. That's not bad given where the world is at the moment. I think, and on top of that, that's pretty good given that the world is still sort of underweight Asia at the moment, because a lot of capital has flown out over the last couple of years and hasn't returned anywhere near the highs of pre-GFC. And invariably, as the world gets more comfortable, capital will continue to flow, to Asia when risk is back on. So the REITs are in a pretty interesting spot. Cost of funding is not overly expensive. Bank liquidity in the region is pretty good. people can get refunded at quite low rates. In fact, the more forward-thinking REIT managers out there are diversifying away from just bank funding, even though bank funding is there, to term out their duration of their debt. It's quite extraordinary what's happened this year. I can just speak from a Stand Chart point of view. We're in the middle of the year now, and we've done 25 publicly listed real estate bonds. That's actually quite extraordinary. So people are terming out, they're diversifying their risk profiles because it's an uncertain world. Are the banks going to be there tomorrow? Probably. But do you want to have all your eggs in one basket? Probably not. So there's a lot of capital recycling going on. So from a REIT point of view, sitting here in Singapore at the moment, or as with George in Hong Kong, you're in a pretty decent zone given that the weight of capital hasn't come back to Asia yet. Now the markets are very open, so capital flows in and out, quite regularly, and with extreme volatility. But if you're of the view that it's out, and eventually the world will stabilise, even if they have to keep printing money until it goes out of fashion, you should be pretty bullish Asia. On top of that, most economies here have got negative real interest rates. There's headline inflation and there's actual real inflation that people are feeling. So if you've got negative real interest rates, it forces you to be an asset owner. So what have we seen of late in terms of the capital flows? And I think top of the pops at the moment must be the private banking money. Because the institutional money hasn't come back to Asia anywhere near to where we think it will be once the world stabilises. But the private banking money has been flowing into Singapore for the last couple of years. And you see with every bond deal, with every equity raising, the private banking money is there more and more and more. And the diversity of product here that are on offer for a REIT or for private banking clients to invest in is getting broader all the time. You've got unsecured bonds, you've got secured bonds, you've got perpetual bonds, you've got CBs, you've got the whole sort of gamut. And I think the REIT managers are getting more sophisticated over the last sort of 5 years, diversifying their capital base. And as a consequence, in a world where investors are short, well, not short, but there's not enough yielding product around, REITs with predictable, stable earnings, have maintained a pretty competitive position, given that the capital hasn't really flown back to the region yet. We're in a low interest rate sort of environment. As I've said, I think some of the REIT managers with great foresight, whilst the short-term cost of some of these capital market instruments might actually be less or it might actually be more, I think the diversification component and the terming out of your debt, is far more important, and we're seeing a lot of that activity at the moment. So if you're a subscriber that the world will eventually settle down, whether it be by printing money or European politicians getting their act together, you would think that, the balance of probability is that Asia, in some time in the next year, and it could be the second half of the year, we'll see significant inflow of funds. I think it goes to the REITs first, the REITs pop, and then I think you'll see equity capital raising. You may see a few IPOs, you may see quite a lot of placements. And then it'll rotate out of the REITs to some, in a relative context, maybe not in an absolute context, but in a relative context, and it'll finally get to the developers, which are trading at big discounts to NAV. But in an uncertain world, people like, and certainly the private banking clients, to get a significant proportion of the return out of yield, and that's what the REITs offer. So, I think they're in a pretty good spot at the moment.
Thanks, Mark. I think we can move on to the next topic that's perhaps will be of interest to all of us, would be the growth strategy of the Asian REITs. Obviously, we have seen both growth strategy via organic and inorganic growth. AEIs that many of the REIT managers here in Singapore and across Asia that have done for the assets to boost growth, and also obviously acquisitions across the region. As company-wide, I think we must have facilitated close to 3 billion worth of assets acquisition, Singapore, Australia, and that's been a real draw for our business. And I think across Asia, obviously it's a lot of Asian funds buying to Asian properties. So perhaps the views of the REIT managers again on the strategy for growth, whether is it organic, inorganic, and perhaps a trend going forward in the next 3 to 5 years. Lynette, your take on that?
2 years ago, 2010, it was after the global financial crisis, CCT unveiled a portfolio reconstitution strategy. It's also in response to some of the lessons that we learned during the global financial crisis. And we examined our portfolio and felt that there were assets that had reached an optimal stage of their life cycle, in which if we held them any longer, we may not get incremental returns. So the decision was then to unlock the assets, and that means divesting them and use the sale proceeds to reinvest into other longer-term sustaining projects. So what we did was after we divested 2 assets, and at one was 11% above the value, the other 45% above the valuation. Now the 145%, why? Because we had an asset that was located in Orchard Road, at the back of Orchard Road. Office building in Orchard Road doesn't really make sense behind apartments, behind shopping malls. So lack of visibility, and we felt that there could be more to do with the asset. We had faced some pressure to lease out vacant space. So what we did was we found another angle, and that was to convert that to residential, because it's Orchard Road area. So we had the permission granted from the authorities to convert part of that to residential and partly commercial. Now, given that we are an office REIT after all, I think investors wouldn't like it if we embark into residential. So we then thought it would be better, right? John will agree. So we thought we made better sense to sell to a residential developer, or we actually went to the market to source for the right buyers. And we did it in good time, because after selling it, the authorities slammed down the anti-speculative measures on residential market. So we got out in a pretty good time, and at 45% above the valuation as an office property. So with the sale proceeds of about $570 million, we then had to see what opportunities we could to use the money. Well, first of all, we were faced with negative rent reversions that I mentioned earlier. There was downward pressure on DPU. So what we did was we used part of the sale proceeds to pare down our debt, and that helped to reduce our interest expense, and that helped to prop up our DPU. Then with the balance, we used that for organic growth, and part of that we used towards the refurbishment of a building called 6 Battery Road. It is a Grade A asset in the heart of Raffles Place, and it's 27 years old, but we've had very good tenants in the building. At the height of the market, we were achieving $21 per square foot in rental, and always 95 and above % occupancy. So given that we needed to be more competitive with the market, and seeing that there was going to be huge supply from the Marina Bay area, we did an exercise on seeing how we could improve the technical specifications of the building. So not just cosmetically it's improved, but technically, and we've also enhanced the environmental sustainability of the building. And this is an ongoing project that will end of next year. It's a 3-year project, because we had to ensure that in the midst of doing the AEI, we still keep our tenants in the building. The building contributes to about 25% of our portfolio income, so it was necessary to keep that. Now, we're very happy to say that in the midst of this upgrading, we've managed to achieve rentals comparable to those in the new buildings. I would say that it's been a success. At the same time, by incorporating environmental features in the building, we're able to reduce the operating expense for this building as well. So that's one aspect of the AEI we did. Another one is Raffles City, which we own jointly with Capital Mall Trust. It's a building which has got a lot of potential for AEIs, especially in the retail area. For those of you who know Raffles City before, like 5 years ago and now, you would see a total transformation of especially the retail mall side. We've added more floor area, and we've converted also part of the parking to shopping, to retail space. And that has generated more income for the REIT. And one of the very exciting projects we're also doing is is also converting one of our car parks into a Grade A office buildings. CCT is fortunate to own 2 public parking stations, or the only 2 public parking stations in the CBD, both of them very well located. But we felt that may not be the highest and best use. Although now parking charges are increasing, so we still keep the other one, and we're getting good money from our parking charges. So one of the other one, we then had a permission from the government to convert that to a Grade A office space. Now, it's very difficult to buy land in Singapore, as you all know, especially in a very good location. And so that gave us the opportunity to develop a building on a very strategic site, and that's just opposite the Raffles Place MRT station. So we're doing that. Now, under the REIT guidelines, there are caps, there are limits as to how much a REIT can develop, conduct development activities. So we are partnering Capital Land, our sponsor, as well as a Mitsubishi Estate in this redevelopment. Now, this building will be completing in 2014, the end of 2014, and in that year, there's not going to be any other office building completing in the CBD. So we hopefully can capture the entire year's office demand. So we timed that quite carefully, all these projects, and we looked at the property market cycle as well, and the rental cycle in conducting all these organic growth activities. We still had some money left from doing all these, at the same time maintaining a very low gearing of 30%. So with the balanced money, we then acquired an asset that is brand new, almost Grade A in quality, that's very close to our other Grade A asset, Capital Tower. This building that we acquired is called 20 Anson, and it's fully leased, 2 years old, and the value proposition is that it is severely under-rented. The average passing rent in that building is only $6.20, whereas the market rents are at $8.50. So we thought it was a good opportunity to acquire the asset, and this is about the only building in the CBD that will be faced with positive rent reversions because of the under-rentedness of the property. So these are some of the activities. So we are, excuse me, while it's quite inevitable with the negative rent reversions faced in the office market, we are preparing for the future, for longer-term sustainability of the REIT. And it's just having to manage the current challenges at the same time preparing for growth at a later stage. And hopefully it will happen from next year. Thank you.
Thank you, Lynette, and for your views on the strategies that the REIT has on the office space and about capital recycling and how that's put to good use. Perhaps move our views from the office to the retail sector, whereby we are faced with the Gen Y and Gen X with bigger spending power, perhaps also asking for a different sort of experience in terms of retail space and expectations, and also what the REIT managers are asked to do in terms of growth strategies from unit holders' point of view. Dr. Choo?
Yes, thank you. Actually, the retail industry faces a lot of problems, including different consumer patterns, changing tastes, multiple tenants, and so on. But fortunately for Singapore at least, falling rents is not one of them. So our growth strategies in FCT consists essentially of organic acquisitions as well as asset enhancement. So let me touch on each of the three briefly. In terms of organic growth, our rental reversions for the first half year, for instance, this year is around 10 to 12%, spread over a 3-year period. So that's pretty good. And that has been very much the same story for most of the last 5 to 7 years. So you got a very healthy rental growth. Aside from tracking inflation, of course, you also don't want to burden the tenants, the retailers, too much. So you have to continue to do things that will support their business, enhance their profitability, like enhancements, like advertisements, and so on. So retail is one of the funny industries where not only do you have to worry about your customers, namely the tenants, you have to worry about your customers' customers, the shoppers. And together, in collaboration with your tenants, you try and make a good story out of your shopping malls. The second prong of growth, namely acquisitions, is something very much also one of FCT's key considerations, because we are currently still not big enough. Okay, we only have access about 1.8 billion Sing dollars. So we're still in a growth phase, and we continue to acquire assets. We acquired 2 new malls in 2010, and last year we acquired another mall, Bedok Point. And going forward, we have a few more in the pipeline. Interesting to note that the Orchard Road building that Lynette sold was bought by Frasers. And one of the reasons for Frasers buying that, which is the developer Frasers, is because the building sits behind Centrepoint, after which our trust is named. And Centrepoint has the potential to become a much greater, more vibrant place if you are able to expand both its retail as well as other offerings, becoming another keynote in Orchard Road they once were. So the acquisitions part, when we executed it over the last 2-3 exercises, did very well for us. The assets were acquired at a very reasonable price, reasonable both from the buyer and seller perspective. And after the injection into the REIT, we were able to increase its productivity. We, of course, then led to higher DPUs. But let me now go on to the third and last, but the most important, I believe, strategy for growth for retail REIT, which is asset enhancement. We have found that this is the most powerful engine for growth. When you have a mall that is either aged or not properly configured, and you're willing to take the plunge to do something about it in a big way, the returns can be highly rewarding. We have done asset enhancements for 3 of our malls. In the first case, a smaller mall, the increase in net property income was 100%. We doubled the income. Then we went on to 2 bigger malls, and the increase was still pretty spectacular at 30%. And currently we are doing the biggest asset we have called Causeway Point. We're nearing the end of the exercise. We projected a 20% increase in income as a result of the asset enhancement. And we are happy to have guided the market that the outcome is even better than the 20% increase. So considering that that asset contributes 50% of our revenue, we can understand why of late the DPU for FCT has in fact seen unprecedented highs. And we firmly believe that if done properly, asset enhancement for shopping malls is the most powerful, as well as something that can be repeated over time in order to grow the REIT in perpetuity. I should also mention that we have an interest in some Malaysian malls through Hector REIT listed in Kuala Lumpur. And they too have been able to realize significant increases in their revenue through good execution of asset enhancement, refurbishments of malls that come of age. So those are the three main engines for growth: organic, asset enhancement, as well as acquisitions. Perhaps I should also mention a little bit about maintaining an efficient capital structure. You have heard that the REITs in this room and also in general are now very healthy in terms of gearing. And the low interest rate environment, as Josh has pointed out, allow us to refinance and lock in borrowings at very attractive rates. So for example, we normally go on 3-year and 5-year tenures. So when we refinanced one of the loans last year, a CMBS into a simple bank loan, the interest rate saving was significant. We managed to get a 5-year paper at below 2% all in. So you can understand how this has contributed also to the revenue stream. Decreasing interest costs is very substantial. And of course, in Singapore, there are about 26 or so REITs. Traditionally, about 4 or 5 will trade above NAV, and we happen to be one of those that are trading about 12 to 15% above NAV, which puts us in a good position to raise capital from equity issuance. Unfortunately for retail REIT, we have to confess, finding good assets to buy is very difficult. So that has actually been the reason why we have not really been going to the market on that basis. But overall, I think together with the very benign interest rate environment, retail REITs in general have been enjoying pretty good growth sort of track record, especially in the sense that these happen to be the asset that is also the most productive in this volatile period. Thanks, Lin Choo.
Thanks, Dr. Choo. Looks like the Singapore market spins a pretty good story for the managers. And perhaps move on to Hong Kong market. How are the strategies like in Hong Kong in terms of trend and expectations from unit holders for the REITs development?
Strategy is very similar in the three different aspects of asset management, improving our revenue, controlling costs, asset enhancement, and acquisition, which we started recently. In Hong Kong, the REIT code does not allow us to do any development, so that's an element that we don't have compared to S-REIT. For asset enhancement, we have out of 152 properties, we have upgraded 25 of them. And a similar experience, the return has been very good. One of the property that we completed last year, we spent $162 million Hong Kong. We had a 36% return on investment. And so we're looking at doing more of these. For acquisition, it is difficult, partly because in Hong Kong, I think to some extent here as well, a lot of the developers are still holding on to the asset, and not too many of them are willing to let go of the steady income. They may not be managing it as well as we think we can, but it's taking a bit of effort to unlock them. Asset enhancement itself is also something new, because if we, those who understand our property, which was previously owned by the government, since they were built 20, 30 years ago, they basically haven't touched it. So for us, when we do the upgrade, it is really bringing the shopping center up to date by 20 years. And what that does is that in the first cycle, we're not even getting the full rental. So we're now moving into getting the second rental cycle from the asset enhancement that we did 3-4 years ago. So I think this allows us to see quite a long tail. For a lot of the commercial asset owners, usually I don't think we are smart enough to finish one asset enhancement project and everything is fixed and it's running perfectly. So usually you operate the asset for a while and then you realize by fixing 2 corridors and then you screw up 1 corridor and fewer people go there, so you need to do more work again. So, I think we're just constantly revisiting some of the assets that we have touched in the last few years as well, which continue to give us ongoing organic growth within the portfolio. I think we also, the issue we have is encountered by any large fund with 76 billion of valuation. There's not a lot that we can do that make a big impact unless we buy a portfolio, which I'm waiting for Mark to show us. It's every little bit helps. So that's why we have all these different elements of the strategy working all at the same time, and everyone adds some to the DPU. We are conservative enough not to really seek for something transformational to add significantly to the whole asset base, because it's just already quite large.
Thank you, George. I suppose it's a good time to ask the banker here about the organic growth strategy, and in the current low interest environment, and the notion of could perhaps be a lazy balance sheet when the gearing is seen to be too low. Is it a good time to go on asset buying spree just because the interest rate environment is low and you take advantage and do yield accretive acquisitions? Or what are your views, and what are the trends perhaps in Singapore and Hong Kong, or perhaps Malaysia, in terms of interest rate environment, or the disciplines that the manager should have in this sort of environment to whether into enhancements or into purchase? Okay.
Firstly, I don't think a REIT manager should do anything just because they've got cheap finance or cheap and competitive cost of equity. It really depends upon the strategy each manager has to add value to the REIT, create earnings accretion and NAV accretion, so they win the support of the investment community, who contribute capital. So just because the capital is cheap doesn't mean you shouldn't use it wisely. So it happens at the moment, global interest rates, are on a downward trend, and I think what's happening in Europe and the US, it's probably not going to change. Banks are in a different zone, Basel III and things like that. Margins are going up, whichever way you want to look at it. So hence the need to diversify capital base via the public markets and the like, I think is very important. Having said that, in this part of the world, the banking environment is generally, very liquid, and there's sufficient capital for the property players to get bank capital if that's what they want. Interest rates, or all-in cost of funding in a financing context, is at pretty low levels at the moment, and best-in-class operators are getting even more competitive cost of capital in a financing context from the capital markets. At present, the weight of money looking for yield product and that is focused on Asia is sitting in the fixed interest spot. It's sitting in the DCM markets. It's not sitting in the equity side. But as I said before, the cost of equity of the REITs is still in a pretty decent zone. Whether you use your competitive cost of financing for organic growth or acquisitive growth, it really depends on the vehicle in question, what the opportunities are, to further each of those sort of themes. So, I don't think, I think generally investors like to see managers sweat their assets and get the most out of assets. So the first port of call is always organic growth if you can do it, whether that means refurbishing a shopping centre or developing an adjacent piece of land or something like that. So I think, organic growth is actually expected. It's not really an option, because if you don't pursue organic growth, you're going to be relative uncompetitive to your peers. So I don't think that's an option. I think that's incumbent upon each manager to strive to achieve. The acquisitive growth, it's nice to have. I can tell you today that there's very few, if any, equity investors buying a REIT and paying for acquisitive growth optionality. In bull markets, people pay for growth and acquisitive growth. In more challenging markets, people tend to look about this far in front of their face and pay for what they're getting now. So, if REIT managers are looking at acquisitive growth, which they all are if it makes sense, it needs to be very compelling. I think those opportunities arise, all the time, but it's a nice to have. The problem, looking at the REIT market for the last 20 odd years is, when there's a bit of momentum in the market and everyone gets on the earnings accretive acquisition bandwagon, people get a little bit deluded and see REITs as growth stocks. They are not growth stocks. As soon as the market starts to think of REITs as a growth stock, it's the beginning of the end. Well, historically anyway, let's see where we go in the future. They are not growth stocks, they are yielding stocks. They cannot compete with equities in a bull market. Maybe in the early stages of a bull market, yes. But through the cycle, no, they can't compete with equities. But, they have their place in an asset allocation context, and particularly in a world which is lacking confidence, lacking leadership, yield products are a nice place to be. So I think if you can enhance your distribution profile, your NAV profile in a accretive manner via acquisitions that are sensible, on strategy, it's a nice thing to have. And if you do acquisitions well, you'll get rewarded for it. Just growing funds under management, is really not a sustainable strategy for a manager.
Thanks, Mark. And now we perhaps have the views of John in terms of investors' perspective. What are the views of investors on organic growth, inorganic growth in the REIT space?
Yeah, I'd reiterate what Mark was just highlighting there, that organic growth is expected and sweating of the assets is expected by investment managers. And I think it's actually an important consideration too about to consider where the cost of equity is for the individual REITs or property companies that are trading on the various exchanges. I think the panel's kind of highlighted a bunch of various strategies at this point. I think when your cost of equity is low, you've got so many kind of tools in your toolkit to be able to add value at the NAV line or at the earnings line accretively, through, issuing equity to finance acquisitions as an example. But when you're trading at a discount to NAV and your cost of capital is quite high, you need to be a little bit, more entrepreneurial in how you're actually growing your earnings base. So as an example with CCT, trading assets, say realising a building at 100 cents or 146 cents in the dollar, and then turning around and actually buying your own equity at a discount to NTA is an incredibly value-enhancing transaction in our view. So we're supportive of those kinds of strategies. I think it depends on where you are in the property cycle and where you are in the cost of equity cycle. I think as a general rule, as an investor, we're more supportive of groups that have an integrated operating platform as well, that have a demonstrated ability or have the capability in-house to sweat the assets, to undertake the asset enhancement initiatives, maybe backed by a pipeline of assets in the parent or some access to other assets that it can get its hands on as well, rather than having a preference for a typical asset collecting vehicle, which may not have all those skills in-house. So as a general rule of thumb, we're focused on that. I'd say as well that if there is a demonstrated ability to value add across the portfolio, we'll probably give a little bit of value for that. We've always been a little bit cautious about overpaying for blue sky in in the good times, but sometimes pricing, as Mark highlighted, gets a little bit crazy at some points in the cycle. But I think we have to also be mindful of how groups are actually generating their growth. I'm very cautious about cross-border transactions where a REIT may be diversifying in other markets and using a cost of capital arbitrage, say financing an acquisition in other markets using Singapore dollar debt and maybe not hedging it back into Singapore dollars. I think that actually highlights an additional risk to the income stream and the NAV of the underlying REIT itself. So we're pretty cautious on that. So I think it's horses for courses. We take a very cautious look at inorganic and organic growth and make a risk-adjusted assessment for that.
Perhaps it's a good time now to invite the audience from the floor, whether there's any questions you have for the panelists here. Looks like there are no burning questions from the floor. Otherwise, I'd like you to join me in thanking the panelists here with us for a very good interactive discussion that we have had.